Well done so far. We have already learned about the financial ratios measuring a firm's liquidity. Let's go over ratios that will help us capture efficiency. Imagine you are the manager of a large retail store chain and that you stop by your warehouse on January 31st. How much is the value of all the goods you have in stock? Let's assume it is precisely $56.576 billion. Well, $56.576 billion is precisely the value you will see reflected in your balance sheet under the account named inventory. To put things in perspective, you also take a look at the total value of inventory you sold over the entire year, which is $463.721 billion. You can find that value in your income statement under the account named cost of revenue. It is also referred to as cost of goods sold. If you sold $463.721 billion over the entire year, but you generally maintain around $56.576 billion in stock in your warehouse, it roughly means you sold and replenished all of your inventory around 8.2 times on the fiscal year ending on January 31st of 2023. So you sell and replenish all of your inventory 8.2 times per year, which means it takes you around 45 days to sell all of your inventory. This quick calculation of the number of days it takes you to sell all of your inventory is called days of inventory outstanding. It is actually a highly relevant ratio. For instance, if your next shipment is delayed, and it will take more than 45 days to reach you, you should probably consider a contingency plan. Also, this ratio may help you manage your inventory more efficiently. For instance, retailers usually aim at keeping this ratio between 30 and 45 days. Think about it briefly. If a hypothetical firm has a days of inventory outstanding of 200 days, it means you are probably buying too much inventory, and hence you are parking your cash for too long. Probably with no need. You could buy a smaller amount of inventory, which involves a lower commitment of cash, and you can replenish your stock more frequently. Another important efficiency ratio is the receivables turnover ratio. Imagine you are the manager of a large firm and that you stop by your accounts receivable department on January 31st. How much is the value of all your receivables outstanding? Let's assume your team informs you it is precisely $7.93 billion. Well, $7.93 billion is precisely the value you will see reflected in your balance sheet under the account named Receivables. To put things in perspective, you also take a look at the total value of revenues for the entire year, which is $611.289 billion. You can find that value in your income statement under the account named Total Revenue. If you sold $611.289 billion over the entire year, but you generally maintain around $7.93 billion in receivables outstanding, it roughly means you collected all of your receivables around 77.09 times on the fiscal year ending on January 31st of 2023. So you generally collect your receivables 77.09 times per year, which means it takes you around 4.73 days to collect your receivables. This quick calculation of the number of days it takes you to collect your receivables is called days of receivables outstanding. It may be also called days of sales outstanding. It is also a highly relevant ratio. But does it make sense that this firm collects all of their receivables in only 4.73 days? It does if you're a retail store. In this case, most, if not all of your sales, are settled in cash. Another important efficiency ratio is the accounts payable turnover ratio. Imagine you are the manager of a large firm and ask your team, on January 31st, how much is the value of all our payables outstanding? Let's assume your team informs you it is precisely $54.729 billion. Well, $54.729 billion is precisely the value you will see reflected in your balance sheet under the account named Payables. To put things in perspective, you also take a look at the total value of the cost of revenues, also known as cost of goods sold, for the entire year. This value is $463.721 billion. You can find that value in your income statement under the account named cost of revenue. If the cost of revenue is $463.7 to $1 billion over the entire year, but you generally maintain around $54.7 to $9 billion in payables outstanding, it roughly means you paid your supplier invoices around 8.47 times on the fiscal year ending on January 31st of 2023. So you generally pay your supplier invoices 8.47 times per year, which means it takes you around 43 days to pay your suppliers. This quick calculation of the number of days you'd take to pay your supplier invoices is called days of payables outstanding. It is actually a highly relevant ratio. As a manager, you will generally push towards reducing your days of inventory outstanding. You will also try to reduce your days of receivables outstanding. However, you may in turn negotiate with suppliers to achieve longer days of payables outstanding. Finally, after you pay your supplier, you may want to know how long you will have to wait until you receive the cash back plus the profits. This can be measured by the cash conversion cycle. From the DIO measure, we know that once you have your products displayed on your shelves, it takes you 45 days to sell. Next, once you sell the product, it will take you 4.73 days on average to collect the receivables. We know this from the DRO measure. Hence, if you paid your supplier on a cash basis, it would take you 49.73 days to get your cash back, plus the profits, after you buy the goods. However, since we know from the DPO measure that you have roughly 43 days to pay your suppliers, you can pay your supplier 43 days later, and for that reason, you only need to wait roughly 6.73 days to receive your cash back, counted from the moment you pay your supplier. I hope this video was helpful to illustrate these different efficiency ratios. We so far covered the inventory, receivables, and payables turnover and the associated days of inventory, receivables, and payables outstanding. Please contact your instructor if you have any doubts or concerns. Keep up the good work.